All right, I'm back again. That was terrible. I don't know what happened. I do not believe I cut the connection, but I may have. If we continue to have technical problems, I'm just going to send you some review videos, but um, worst case scenario, that would be the case. Otherwise, I'm just going to continue talking and not worry about the chat disappearing. So let's see. I'm going to try and keep this stream alive. It just seems to cut out occasionally. Not sure what that's about. Okay, let's wait for you to come back on. Tells me it's an excellent connection. I think it might be my own computer cutting the connection. It seems to do that sometimes. All right, we're back. So I'm going to just continue, even if I break the connection and we don't manage to save the chat, because that's my biggest concern, it seems. I'll just keep talking. And absolute worst case scenario, if this doesn't work, I'm just going to send you videos. All right. All right, so remember to refresh your screen. So what was I saying? I was talking about the capital asset pricing model, and I was talking about the origins of it really are here, where I have the risk and return axis and I'm combining risky assets with the risk-free one. And I mentioned that this line represents the possible linear combinations or combinations of the market portfolio, which is identified as the preferred portfolio out of all of these, where a little bit of every asset is contained, and it is going to be proportionate to um, the asset's relative market capitalization, relative to the entire market. So they're all contained in here. And then a person investing here would be a person who's just invested in the market portfolio. Anyone in here has combined the market portfolio with a risk-free asset, or the T-bills, as the example I explained. The x-axis for the CML is the standard deviation of the portfolio. It comes from here. All these calculations we did, right? If you remember back, I showed you how to calculate the standard deviation for two assets, but I also showed you how to combine more assets into one. So you would have to use this formula to combine with relative weights that sum to one all of the assets in the market portfolio. Okay, so that would be the standard deviation of that. Oh, I should correct this. This is a square, right? Because that's the variance. And the standard deviation is the square root of that. It says it up here. So that's what the variance is, and we take the square root to get the standard deviation. So that's what's on this asset. So it's a measure of risk. And here we have the expected return of the portfolio. So anywhere you are in here, you would have the standard deviation and the expected return. So any choice between here and here includes the fraction of the market portfolio So the individual, if they've invested $1,000, they could invest, let's say, 600 in the market portfolio and 400 in the risk-free asset. And that would be somewhere between here and here. So essentially what they're doing is investing by lending money, by buying T-bills and $400 worth. And oh, sorry, I should be clear. That's not the weight. That's just the weight is actually because it has to be over 1,000. So XM would be 0.6 and XF would be 0.4. I'm not sure if you heard that. I had to blow my nose. The x-axis is the standard deviation. It's right here. All right, so any of the combinations over here, however, are borrowing the T-bills rather than lending towards the T-bills. You would be borrowing, short selling at the risk-free rate, and then using the proceeds of this sale of the T-bills in the market toward the market portfolio and expanding the possibilities beyond these, all with higher risk but also higher return. So all of these represent the trade-off of risk and return, and any investor chooses depending on their risk tolerance where they want to be along this capital market line. So what we're going to do then, or what I discussed, was now I move on to entering risk and return for each asset. So each and every asset in the market, risky, riskless, are plotted here. And they will plot on the line. Okay, they will exist on the line. So all assets, all portfolios, all investment projects are happening here. And I'll explain why. What's plotted so far is we have the risk-free asset. This is its return, expected return, and its beta. The beta of the risk-free asset is 0. So that's why it's there. And I mentioned last class that betas could be negative. It could go back here, beyond. So what would be a negative beta? Well, what is beta again? Beta is the sensitivity of returns to market returns. Oh, we're buffering again. All right, I'm just going to continue. Can you hear me? I don't know why it's buffering. Yeah, I know, this is really bad. So you know what? Do you want me to continue, or do you want me to just send you a video? I'm not sure. I gotta check out what's wrong with the stream. Maybe I have another cable I can use. How's it going? Okay, let's try one more thing. All right, I just changed something. Let's see if that helps. Just a little buffer. Okay, let's try this for a bit. See how we do. Well, we're gonna lose the chat, but I'm just gonna continue because it's crazy. All right, let's work with that. I'm very uncomfortable because the cables are too short. But... Okay, so what were we saying? So every asset is appears here. And you see the I represents each asset, and this is a measure of its risk as it is measuring the sensitivity of its returns to market returns. So that's risk, and then on this axis is the return. This is the expected return of the asset. So we use the symbol ERI, remember, this is the expected return, and we use that when, in general, whether we have ex post or ex ante data, that's what we use as a symbol. So this is known as a pricing model, and you should have learned it in FINA 3106. And it's pricing to the extent that as long as I know the beta of the asset, I can find its expected return. So I marked here, these are the two that I know about. The risk-free asset, I know its expected return, and I know its beta. The beta, what is the, so you have to ask yourself, what's beta? Beta is the sensitivity of the returns to market returns. Well, because risk-free implies that it's not responding to market volatility. There's no risk when you hold T-bills. Um, you're going to be guaranteed your return because it's backed by the government. So then we say that it's not variable, volatile relative to the market returns. So that's why that's there. And then here we have the market return. This is a representative of a composite index, or this represents a portfolio of all assets in with weights that are proportionate to their representation in the market, or their portion of market capitalization of the entire market. So this beta is 1. Why? Because the sensitivity of market returns to market returns, that's just an identity. That's just 1. Okay? And then we just use the symbol for the expected return of the market. So Mr. L asks, how do I get the beta without knowing the market? Well, if you know the beta of the relative portions, you can do it. So that's what we're going to show you. So during the week, I was hoping that you guys would have looked at the assignments or all the exercises I gave you. But anyway, we'll look at some of those together, but you should be working through those. So what comes out of this is a line. And I asked you last class, what is the slope of the line? Now the slope cannot be the beta, right? Beta is the x-axis. So the slope actually turns out to be this. And this is the market risk premium, whereas we talked about risk premium of assets or asset classes. Remember calculating this back in the earlier set of notes. Now we're talking about the market risk premium, not just the risk premium of each asset. I'm talking about the market portfolio and how much more investors need to be compensated to invest in a risky asset over a risk-free one. So this is called the market risk premium. So what does this say? This says that, and this is the capital asset pricing model, it says that we can identify the expected return of any asset as a markup over and above the risk-free asset, since investors will hold the risk-free asset at least to hedge against inflation, but will be expecting a return to compensate for each unit of risk. What do they expect? They expect the market risk premium. So for each unit of risk, they expect the market risk premium. Okay, so you see, if if it's risk free, if they're holding, if you're trying to price, sorry, the market risk premium, then the beta would be 1, this would be 1, and then you would just be left with this plus this minus this, so just the expected return on the market. So this would be give you that. So this is a tracing exercise really to identify any return along the security market line, as it's called. So I have many examples of that, Misael, in the notes, and you can practice that. And we'll do some here. How we find the beta without knowing, sorry, how we find expected return without knowing the beta. Now, I mentioned this is a pricing model, and then why is it the price? Well, because remember how we calculate price for risky assets. This is a simpler model. This is the perpetuity. Remember we said if we assume that the required rate of return is the same indefinitely and returns accrue at C1 forever. So this is like just the perpetuity model, right? So if I make those assumptions, then this would be the price. And what am I actually doing now in this unit? We're learning about finding out what I could be. Remember, before we got to this unit, we were learning about cash flows, how we figure out what the cash flows are, future cash flows, and then we were valuing them to assess the value of projects. And now what we're doing is actually going after what is the appropriate risk-adjusted rate of return. And I've just shown you one model to help you calculate it. So we have one model for calculating this. And in that way, finding the expected return is equivalent to finding the price, right? They are inversely related. And yeah, that's how it goes. So the security market line is always linear. Although the capital market line was just for efficient portfolios, the security market line includes any security and portfolio efficient or inefficient, whether people choose it or not. Okay. Notice that the the beta is 0 means that you have an asset that is equivalent in return to the risk-free asset. So even though I've just plotted 2, anything that falls here, there could be other assets that have the same return as the risk-free. asset as long as their beta is 0. As long as their beta as long as their returns are uncorrelated with market returns, they'll end up having the same return as the risk-free asset. Um, um, so, right, there's no risk if you end up here. So if you combine portfolios in a way to eliminate risk completely, and we talked about when that's possible, right? We talked about that back here. Here you can completely eliminate risk. Now, that might not exist. That's only happened to be the case when the correlation between two assets was -1. But you could approximate that result. All right. So all securities are in the market portfolio. All investors have the market portfolio in their portfolio since they are all on the new efficient frontier, investing in both the risk-free and the market portfolio. Investors are only concerned with the expected return on the market portfolio and the standard deviation of the market portfolio, and with the contribution of each security I to the market portfolio in terms of the contribution of systematic risk as measured by beta and the contribution of expected return. So all we care about is the expected return as we compute, and we compute it by considering the influence of the market returns on your asset of interest. All right, so you need to remember all these formula and where they come from. And I left you with this. So let me give you a couple of minutes. So that was actually a review for the last 45 minutes. I'd like you to solve these if you haven't already. I'll give you a couple minutes for that. And then we'll get to the more complex problems. So we've done well. We've done well without losing the connectivity. I'm just waiting for you guys to work this out. How's it going? Okay. You hear me? Okay. So what you have here is information on two stocks, and you have their risk measure. So with their risk measure, we can trace their return through the capital asset pricing model line. So with a of 0.8, so let's see here. So that should end up, I'm trying to make it a straight line. It should end up here, a little bit under, right? It should end up over here. So this is A, or beta A. It's equal to 0.8. So then that means that the expected return to A should be less than the expected return to the market portfolio. So let's see what we get. So this is going to be the risk-free plus for every unit of risk measured by the beta, we adjust by the market portfolio, which is given to you as 14% minus 4%. I'll just write the symbols out first and then I'll. Right, that's the market portfolio. So now we put the numbers in. So this is 4% plus, remember the beta is an index. It's not, it's an index, right? It's not it's not a percentage. That's 10%, right? The market risk premium. So then you get, what do you get? If this confuses you, can write it all as decimals. What do you get? Uh-huh, 12%. Now let's go back to the graph to see that we expected it to be lower than the risk, the market portfolio. The market portfolio was 14%. So I'm going to just model everything we've done for this exercise. That's 14. Actually, let me use different colors. And this one is 12. All right, so it's just under. All right, let's do the next one. Unless you have any questions. The next one, let's put it in a different color. Let's put it in blue. Same formula, RF plus. Now I need the beta of the stock B. and that's 1.2 times the market risk premium. So 4% plus 1.2 times 10%, or 4% plus 1.2 times 0.1. What do you get? Good. Right? It has to be bigger than 14%, and it is. All right, so let's go to the graph. So I did 1.2, so 1.2 should be here, and the expected return to this asset is going to be 16%. So it makes sense, right? So like we just use the line to trace risk to return. Now, what else can we do with this? So we have two assets. Oops. We have this one here that sits on the line, and we have this one here that sits on the line. Now let's think about combining them. What if we combine asset A and asset B? That's the next question. So the next problem is, consider a portfolio that's partially invested in A and partially in B. 60% in A, 40% in B. What do we know? We know that from our earlier discussion last week that we can find the expected return as a weighted average of the expected returns, right? So that was from rules of means and variances that I introduced you to if you'd not learned it before. The average of a weighted average of assets is just the weighted average of the means, right? So it's a weighted average and you get this. So you can make the calculation and confirm that for yourself. Now, where does this appear? Will it also be on the line? Well, of course it's on the line. It's going to be in between these two. Now this one, now there was more of what? There was more of A in it, so it's closer to A. Just under, I'll make it green. It'll be just under here. Between 12, right, and 14. So that one is going to be 60% in A and 40% in B. So what's the beta of that? That ends up being 13 point, we figured it out, or I figured it out before you, 13.6. So that's going to be 13.6. What did I call it? Oh, a portfolio P. So that's its return. What will be its risk? Again, it needs to trace down. So it's something in between A and the market portfolio. Something between 0.8 and 1. So how can we figure it out? How can I get the beta from the expected return? So there's two things I can do. I can either use the line to trace it down. So I'm gonna take this number that I figured out by, oh, I didn't even write the number, did I? It's 13.6. Can I do this wrong again? Nope. Here you go. So I can take that number which I derived as a weighted average of the averages, A and B, or, sorry, I can take this and use the CAPM to trace down to find the beta, or I can conduct a weighted beta between A and B. I can calculate that. So that's what's here. That's what I've illustrated here. So you can get the mean, 13.6, and in the same way, you can do a weighted beta calculation to get the measure of risk. And again, it's between 0.8 and 1, right? So this is something new. Didn't talk about this before, but it does follow with everything else we did, what we're doing. So this is a weighted beta. This is a weighted mean. Okay. But as I mentioned, this could also be calculated using the CAPM, tracing using that's not very clear, is it? Let's let me show you this way. So let's say we didn't have this. So this would be the CAPM, where I know this and I know all this information, find the beta. So you could solve for the beta from this expression. So either for the return or the risk, you have two ways of finding them. Either you can use the weighted return or weighted beta, or you can use the CAPM in either case. So to solve for beta using the CAPM, you're going to take, essentially you're going to take RF minus expected return to the asset divided by the market risk premium. You don't have to memorize this formula. It's just an algebraic manipulation. I did this backwards. If I want the beta, it's 13.6. So it would be, sorry about that. Well, I'm kind of trying not to confuse you, but I'm managing. Okay, so if you wanted to find the beta, it's just algebraically solving this, but you can also see this as a formula. It's like the portfolio's risk premium over the market risk premium. Exactly. Okay. So again, you can use the weighted mean, the weighted beta, or the CAPM in either case. I'll do step by step. So this turns out to be, like you said, and let's draw it on our graph. So this is going to be 9.6 in green, 0.96, sorry, as beta of the portfolio. Okay, so I've shown you how to price assets knowing their risk as a measure of their sensitivities, the sensitivity of the returns to market returns. And then I found them both on the line, right? I found those on the line. And then I've combined assets into a portfolio, which will also end up being on the line. So just showed you some examples how everything I've done so far ends up on the security market line. So what if an asset ends up off the security market line? I'm going to use purple. What if there's an asset up here? You can call it K. Asset K. Trying to fit everything on here. All right, so asset K. For this level of return, investors in K are assuming this level of risk. So this is the beta of K here. However, other investors in the market, assuming this level of risk, are getting this return. Okay, so this return is available. How can we get this return? Well, if nothing else, we can short sell T-bills and invest the proceeds after selling them on the market. We can invest in the market portfolio and be right here, okay? So we can create this return for this level of risk. So what's going to happen to K? Well, people invest in K. So we assume investors are rational and that they can make these calculations. And in fact, no, they'll move to invest up here. So nobody will want K anymore. So what's going to happen to K? So people holding K will want to get rid of K to go and invest in this instead. This portfolio up here that combines short selling T-bills and the market portfolio. As a consequence, people are going to give away K for less, they're going to sell it for less and less. Presuming that nothing else changes, we'll see unexpected, so that in essence, that market is expecting a higher return for K to continue to be available, okay? This should be an expect, so their investors are using the relevant information and properly pricing K with a higher expected return. So that is, by that discussion, that's how we end up essentially up there. So if K is to continue to exist, it has to give, investors will have this expected return. The ones who are holding it will have this expected return in it. Okay? So it's not, so this is an out of equilibrium result. And we say that currently, before the price adjustment, the price was too high. K is currently overvalued. So assets below the line are overvalued. Assets above the line, let's look at an asset above the line. Let's talk about J. Let's use a different color. These colors are difficult. Am I running out of colors? Okay, I'll just go with the purple again. So let's say there's a J over here. So tell me a story about J. Okay, so right. So J, for this level, so we start with the risk, right? So we trace it down here and we say for this level of risk, which is quite low, for this level of risk, investors are getting this high return. So when investors in the market become aware of this, what do they want to do? They want to buy J, right? J is better than anything over here, even if they did. So if they were to invest in T-bills and the market portfolio, they would only end up here. So why would they do that when they can buy J? So they're going to end up bidding for J. They're going to want J and bidding up the price of J. And as a result, the adjustment process, as they bid up the price of J, imagining that the dividend stays the same, they are simultaneously lowering the expected return. Right? So this will be adjusted up until here. It won't go lower because investors for that level of risk could create the market portfolio and T-bill mix to get this. So they're going to end up here. So as a result, as we can see, the price is undervalued currently and it needs to rise. It will rise given the new information. And so assets above the capital, the SML or the capital asset pricing line, we say they are currently undervalued. So I made a mess of this graph, but hopefully as we went step by step, you follow what I had to say here. Okay, so assets, projects, portfolios off the security market line will adjust to be on the security market line. Right. All right. Okay, let's go into the exercises and you guys tell me where you want me to start. Okay, let's take a 5-minute break, go through the exercises and let me know where you want me to start with those exercises before I move on to the next material. Well, it's related, but I want to see if we can do some problems together first. All right. So for this one here, you're supposed to use the formula that we discussed over here. Remember these formula? All these calculations. So these are the holding period return, geometric average return, arithmetic average return. So I'm not going to do those. You should practice. So you need to use that to solve these. I'm not sure, Marcel, what you're asking. In some cases, solutions use the standard deviation to choose between assets and other the covariance. I'm not sure where that happens. Okay, maybe you're talking about when the standard deviation is used versus when the beta is used. So maybe let me think what you're asking. Maybe in this exercise. So you should practice making all these calculations. Everything I do seems repetitive because I'm teaching you the skills and then I'm applying them. So you have all the tools. It's not this one. It's not that one. So you should be able to do all these now. I think it's here that there's a question that comes up. Okay, so this is not the covariance, Misael. This is the coefficient of variation. And it's a way, if this is what you're referring to, it's not the covariance, it's the coefficient of variation. Is this what you're referring to? So the question here is, if an investor is interested in owning one asset only, which of A or B should they choose to minimize risk? And I calculate the coefficient of variation, which spreads out the risk over the return. So it's a way of looking at risk over benefit, right? And I want the risk to be the lowest, so that's why I go for B here, because the coefficient of variation is smaller. But then here, I use beta instead. If I'm considering adding an asset to a portfolio of assets, I look at I look at the beta, because to minimize risk, you have to think about how those returns interact with the market portfolio. Assuming you're holding the market portfolio and you're adding one more asset, you care about it, how it affects the risk of the portfolio. If the market portfolio is a representative of the market, then looking at the beta is telling you about how it's going to affect, by including that asset, how it's going to affect your portfolio's returns. Is that an okay answer? So yeah, that's coefficient of variation, not covariance. Okay, good. Other questions? Keep asking. And you can also, some students send screenshots with their questions, so don't feel stalled in your studying. If you feel like you're stuck, just send me a screenshot, and hopefully by text or even with a short call, I can clear it up for you. Let's see what else we have here. So I'm all the way into 12. No, where did I go? 13, 14, I'm in 14, 15. So if you're good with that, those type of questions, I can get into the next notes. If you need me to circle back, let me know. Okay, these are the two. I prefer to have the single slides. I don't have that option here. All right, so we have all the tools. We have our statistics. We have our understanding or our capital asset pricing model that relates risk and return. We have all our formula for measuring both of those. And what we're going to do now is return to the UR case as our example with the most realism possible. We are going to try and calculate the cost of equity. So what's the cost of equity? Cost of equity. Hold on, let me do this. So the required rate of return we use for valuing assets or projects is the same as saying cost of capital. It's also used to refer to what's called the hurdle rate or discount rate. These are all the same terms. It's just a matter of the context, right? So if I'm talking about a firm, I could speak about the cost of equity for an all equity firm. So if you have a corporation that only issues stock, it doesn't issue debt, then that's an all equity firm. So these are all the same expression, and we're trying to sort out what we should use. Now, this information here is provided in the UR case part 2, which I shared with you. So I'll just present the data and use it as required or as necessary. Notice I go to a lowercase r here, but it's the same idea. These are the returns. We're trying to find I, right, or R. These symbols are used in different textbooks and different formulas. Like that's what we're trying to find. And this is a way to find it using the capital asset pricing model. So what would we need? We'd need the risk-free rate. We need notice I use an S instead of an I for stock. Okay. And so this firm, the UR firm, we're going to begin by discussing if it was an all equity firm, we could estimate the required rate of return we should use for projects using the capital asset pricing model. Now we have another model to use, but we'll get to that in a moment and we'll talk about which one is better. But for now, we need the beta For UAir, we need the market risk premium and the risk-free rate. All right, so let's begin by getting the beta for UAir. So we'll call it the equity beta. And what is the beta? It's going to be this calculation. We need the covariance of market returns with UAir's returns. And I'm going to use historic returns. I could do this another way. If I had a model to estimate the distribution of returns that are anticipated or ex post data, I could do that, but I'm not going to do that right now. I'm going to give you some historical data. It's old. I haven't updated this just because it takes a lot of work to go get this updated. But anyway, the principle is the same. It's some data from the past that I'm going to use to determine whether UAir should adopt the Bahamas project, remember. So this, we're going to first calculate the covariance of returns and then divide by the variance. So this is a formula for beta. Another way to have done it would be to get, remember, if I had the correlation, so it's like R SY over SX, remember? That's where it comes from. Anyway, that's how I remember. And then you multiply by sigma of what's on the Y is the stock, and sigma what's on the X is the market. So you could do it that way as well, but we're going to do it this way because it's less things to compute, right? It's just two things. So this is the covariance. Now, how do I get the covariance? These are the market returns over these years. These are the stock returns. And do we see a pattern? It looks like sort of high. Yeah, so it's positively correlated, it looks like. Now let's get the exact value, right? Even here, when this one's negative, this is even more negative. So it's more than one and it's positive. So let's use our calculators to enter that data into the calculator. I'll do it to remind you. Let's do this together. I'm turning down the sound to blow my nose. I just have some congestion. I'm not sick or anything, let you know. All right, so let's start entering these numbers. We're going to hit second data, and there's something in there, so I need to clear the worksheet, second clear work. Can you see that? Let me make this a little more, it's not bad actually. Okay. All right, let's start entering the data, right? So I can enter it as a decimal point. So I'm going to put X, remember, as the market, so that one goes first, and then Y as UAir. So 0.0491, enter down, and then 0.1, enter down. Now the second pair, 0.1579, enter down, and 0.3, enter down. And third pair, 0.0549, enter down, and 0.1, enter down. Don't mess this up, 0.37 with a negative, enter down, and then 0.55 with a negative, enter down. 0.2646, enter down. 0.4, enter down. 0.1506, enter down. 0.3, enter down. All right, so that's the data. I'll wait for you. Let's review it, make sure I got it right. Okay, ready? Second stat. These are my linear results. So it's going to give me the number of observations, 6, the mean for the market returns, the standard deviation, and the population standard deviation. I ignore that. Now, these are the returns for U-air, if I didn't make a mistake. Expected return, standard deviation, and the standard deviation of the population, if it was a population data. This is the y-intercept of the line, or the intercept for the stock on the in the plot of U-air returns to market returns, and this is the beta. This is the slope. Okay, so this is the statistics calculation of the slope. Because I have many points and they all scatter about and they don't necessarily fit on the line. Notice the R is good, it's positive, and it's strong, but it's not perfectly one. Okay, so there's a bit of a scatter around, and that's important because it tells me how good a model of prediction this is. Questions? We didn't have to do anything. Use our phones or our calculators to get these values. Does anybody want me to slow down? So we need to pull out of here just the B. We can get the B, that's the beta. We didn't actually have to calculate anything. We used a calculator. I want to show you how to get the other terms as well. Ready? Oh, one more time? You want me to do this again, Nice Beth? Okay. So I entered the data in here in pairs. So I put the numbers in. Maybe I can just do it again. So second, clear work. So start over. Starting from scratch. Do it with me. So it's 0.0491, enter, down. And in pairs, now I use U-airs. 0.1, enter, down. And then 0.1579, enter, down. And 0.3, enter, down. And 0.0549, enter, down. And 0.1, enter, down. 0.37 negative, enter, down. 0.55 negative, enter, down. 0.2646, enter, down. 0.4, enter, down. 0.1506, enter, down. 0.3, enter, down. All right. Scroll through to confirm that I did it right. Everything looks good. Now, second stat. These are the linear results. I have my sample size, the mean of the market returns, the standard deviation as a sample result. This is the standard deviation as though it was population data, which is not. This is the mean of U-airs returns. This is the standard deviation as though it was a sample. And this is as though it was a population, which it is not. This is now, so these were pairs of observations I could graph in a scatter plot. And this would be the prediction line intercept. It's close to 0. And then this is the slope. So this is the slope of the scatter of those two variables in a coordinate plane. So this is my beta, 1.55. So if you did these calculations manually, or if you did it using Excel, and I mentioned if you do it manually to put them in columns like this, first you would get the covariance and then the variance and then divide them, and you see we get the same number. Well, let's see, mine was a little bit different. Oh no, it rounds, well, it rounds, round, round, round. So the difference is because just the rounding. It's just from the rounding. Let me go back and see my results. So this is 11, you see? So we're rounding that 11%. So I just rounded everything, and that's why the numbers are going to be different. Okay. Now my question to you is, can I get this number from the calculator? Can I get this number from the calculator? Okay, so what do I have here? Well, this one I have, right? So this is the market return. So this is going to be X. This is the variance of X. So let's go see. Oh, what happened? So the variance of X is it's 0.22 squared. No, what just happened? Do this again. If I square this, that is the variance, 0.0488. Doesn't that look familiar? So this is the variance of X, or the market portfolio. Now, what about this one? How would we find this one out of the calculator? If to find this one, what is correlation? Now, remember, I'm using the hats here because this is ex post data, so they're estimates. It's not like if I had ex ante data, right? I would use the Greek letters without that sombrero. So here is the covariance. What is the covariance? So correlation of market returns with UR stock would be equal to covariance standardized. Oops. Right? So what is the situation that I have here? I get this out of the calculator, but let's say I wanted this. I could get this if I just multiplied all those things together. So from my calculator, I could multiply R and then multiply it by S, or sigma m would be Sx, and then multiply it by Sy. That should give me that number. Don't you think? So I know I'm jumping around with my notation, but I really need you to follow me because everything comes from the principles here, right? Whether it's an estimate or not, this is the principle. It's the covariance standardized. So let's get those numbers and try. So RSX, SY. So R, let's get back to the results. Second data. Oh, I want the results. So here's SX, here's SY, and then here's R. So let's write them down. And verify. All right, so what I'm saying is this should be R, which is 0.99671288. I guess you could put them all into memory, times SX, which is 0.221012374, which is times, so you could put them all in memory so that you don't have to do this, 0.344111722. And you would be able to find it if you really wanted that. But we already have B or beta, so why would we do that? So let's see if we can go back and do that and multiply them all. And we should be getting this as the result. Let's see, I'm going to store, give me a second, RSXSY. Okay, so I'll do it in that order. So R, I'm going to store 1. SX, I'm going to store 2. And SY, I'm going to store 3. And then I'm going to multiply them. Recall 1 times recall 2 times recall 3. And there it is. Is that the number? I know 758. Yeah, pretty much. Okay, so the numbers vary depending on how you do it. If you use a spreadsheet, use Excel, use the calculator. I want you guys using the calculator, but some of you will use spreadsheets, so you just got to realize how our answers will be a little different. You do that. So basically, beta is more sensitive. Sorry, the UAir stock returns are more sensitive, or they're sensitive to market returns, 1.55. And what do we do next? Okay, so we have the beta of UAir. Now what we're going to do is use it with the CAPM. So we have some more things to consider here. And now I think it was Masseo was asking for realism. So this is how you do this using the CAPM with real data. Okay, you have to make some decisions. Using information on the T-bill that's recent. Hold on. All right. So using information on the T-bill over the last several years, 6 years of data, the average T-bill rate is 2.635. How did I get that? You could put it in your calculator and ask for the arithmetic average. Remember when we look at market data, we just use the average. We assume a relatively or approximate normal distribution. And the average market return is 5.11%. And that comes from over here. Okay. So that the average historical market risk premium, when you put those together, gives you this value. So this is the average. Notice I use the bars. Even though usually I write RF, I'm going to put a bar here. So I'm going to use these to get the average historical market risk premium. So that is approximating this piece. I'm not going to use the RF in here that I use out here because the current T-bill rate is so different from what it was historically, 2006, 2007, 2005, okay? So half of them are much higher than the current rate, but I need the current rate to approximate things. So I kind of want a pattern from this to help with the market risk premium, but I want something more relevant to today. So I'm going to use the current T-bill because it's different than those. It's less than, it's the average rate is 2.3 times higher. So this will be the current one, and then I use the average market risk premium here, or historical market risk premium here, and then my estimated beta, and look what I get. This tells me that I should use a required rate of return for the UARE project of 5.27. Now, if you remember back to the UARE, what was the required rate of return we used when we evaluated UARE? You can go back to your notes, or maybe you have it in memory. If you go back, so previously we used a 10% required rate of return. And we just found using CAPM that it should just be about 5.27. So this makes it more likely, because this is not so high, a return for that level of risk. It's not that high. So this makes it more likely that UAIR is going to accept projects than if you use 10%. So that's really important to know. What if we even went further with the historical market risk premium and instead used all of the data that I presented to you all the way back to 1928? Well, that will be a higher average, okay? And what does it do? What does it do if we use that, if this is much higher? Let's go through the steps. Let's include it now in the CAPM with the current T-bill. And it tells us, aha, the required, so if you do all these calculations, you'll find 12% is the required rate of return. So you see how sensitive your assumptions are, what you put in here are sensitive, or sorry, the expected return calculation, the cost of equity that we're trying to calculate is sensitive to how you actually calculate it. So you got to be thoughtful about what you're doing and don't just do things that maybe were done in the past if the current circumstances are much different. So I recommend that the historical returns are substantially, different than the more recent ones. So we want to make predictions about the coming future, not distant future. So we're going to stick with using the more current data for reliable estimates of cost of equity in the short term. So even though I make this calculation using 3.7 instead for the T-bill rate, and this is the right, and the 11.3 as the historical market risk, sorry, the historical market returns. What did I have before? I was only using 5%, right? Because that was the recent past. Now I'm going to use the historical one, which is 11%. And it changes things. It doubles. It basically doubles the return. So this makes it less likely that you'll accept projects for UAIR if you do it this way. So we're going to stick with the 5% number. Okay, so what I've shown you is your assumptions are important. How you calculate, what is your reference period for the market risk premium is important. It's going to affect your estimate of the cost of equity. In this case, it doubles from 5 to 12. Okay. Okay, so one more way of making this calculation, we're going to go back to what I taught you or when we just first started discussing returns, is the dividend growth model. Remember the dividend growth model? The dividend growth model is a variation of the growing perpetuity. Remember when I said, well, what if we instead use the growing perpetuity? If we can make assumptions, we can rearrange the growing perpetuity pricing formula, rearrange it, and solve for the cost of equity this way. Right, so this comes from the growing perpetuity formula. Right? So what I'm saying here is if I have information if I make the assumption that growth is constant and I know the future dividend in one period and I know the current price, I can estimate cost of equity this way or the required rate of return. So making those assumptions and using this data, I can do this. So let's see, how do I use this data? So notice growth between 2005 and 2011, it is growing, it is positive, but it's not necessarily constant. but we're going to force it to be constant. We're going to say, let's find the rate that's constant. That would be the equivalent of the constant growth rate in that period of time. And the way that we're going to estimate it, is saying there's 6 periods of growth, 1, 2, 3, 4, 5, 6, between 2005, where the dividend was 20 cents, and 2011, where the dividend is 0.25 or 25 cents for every share. And therefore, the growth rate would be what? So I had to solve this algebraic problem. So when you do that, you solve to get a G of about 3.7, so almost 4% growth. So on average, so what I found is the geometric average or let's just call it the growth. Okay, so we found the growth. This is not exactly the geometric average that we talked about where the rates are different, but this is going to give you the factor of growth if it's constant over that period of time. It would be 3.789% a year. And I'm going to use that growth rate and the assumption of constant growth to find the next dividend. So the next dividend should be about 26 cents, but I'll keep all the decimal places because investors invest usually more than in more than just one share. So, you with me so far? So now this is going to go into my formula. So I'm going to have, so this is finding the required rate of return or the cost of equity. I can call it RS, I can call it I. The next dividend is going to be that in 2012. The current price I have been given. You can check in the case that I give you. I gave you the part 2 to the UR case, and you can check that that's given. So this is given. This is from here, and the G is from here. Okay, so we have all those values calculated or given. And when you put it all together, let me make sure that I did this right. I know there was a typo in my previous version. You should get this. So why don't you confirm that for me? Let me know if I made a mistake. How did I do? Looks good? I'll give you a moment. That is given, Messiah. If you read the UR case, it's given as the price. So UR case part 2, somewhere here. It's 5.8. It's document 5.8. So this was given here. Should be given here. Oops. This is not, this is, I knew there was a typo somewhere. So this has to be, I need to change this number. Right, Misael, I did it wrong. So this is a typo. I fixed the typo somewhere, but not here. So this ends up being $4 and what is it? 65. Yeah, I don't know. I had made some changes at some point. I need to fix this one. I'll send it around, distribute it. Are there any other discrepancies you found? Yeah, we're going to talk about the debt in a moment. Verify, maybe it is, maybe it could be that this one is wrong. Hey, hold on. I can't remember which one was the wrong one. Let me check. Let me calculate. Sorry. Let me see. Maybe this is supposed to be 10.25, 72, 7. No, this is way off, isn't it? Okay, let me see where I went wrong. If I do 10.25, do I get anything better? I think that's the better one. Okay, so that's my mistake. So the mistake was not that it's wrong in the case, it's wrong here. I don't know where that number came from. Anyway, it all works out. This one is the one that's wrong, not the other way around. So this is 10.65. So that's correction. So this is the error from U error case, part 2, document 5.8. So I'm going to go back and fix that one now that I've confused you. So this one is not true. This is fine. So that's fine. It's just this one is an error. Probably, anyway, I just need to fix that in my data, my problem sets. All right. So what did we find? We found out that this is not so far off. So if we use a different model, this is called the dividend growth model, we get pretty close, right, to what we had before with the 5%. Our estimate was 5.27, and now it's a little bit higher. So this will, using the dividend growth model, and this carries assumptions, right? We're assuming that growth is going to continue to be constant, and if you're comfortable with that assumption, then you would go with this number. If you're not so sure, then you would go with this number up here that we computed earlier. All right, so I've done 3 different calculations for the cost of equity. One was using the historical market risk premium of the recent past, and I'm going to stick with this one over everything else we've done. The other alternatives were to use the historical market risk premium of forever ago, like this is going back 80 years. And that's just way too high, and it's going to force us to reject a lot of projects. So we're not going to go with that one. And we feel like the more recent past is more relevant. And in the short term for this project, which is a 4-year project, we think it's going to be fine to use. And then just for fun, we looked at the dividend growth model and determined that it's actually not so far off. In fact, we're not going to use it as a result, but it reassures us that we're on the right track with using the 5%. All right. So continuing. So then, but for now, we've